Everyone on Wall Street is short Bitcoin right now, and they're about to find out why that's the most expensive mistake of the year. The funding rate on Binance has been negative for 60 straight days. That's the longest stretch since the FTX collapse blew up half the industry in November 2022. Hedge funds, prop desks, sophisticated traders, they're all stacked on the short side. And yet Bitcoin just closed April up 13%, broke out of the descending channel that's been crushing the chart since October, and is hovering right under $80,000 heading into May. When the most hated rally in years runs straight into the most aggressive corporate buying in history, exchange reserves at a 7-year low, and a Federal Reserve leadership change in 2 weeks, you don't get a quiet weekend. You get the setup for a violent move, and almost nobody on retail Twitter is positioned for it. And this is the Bitcoin Weekly Roundup for Saturday, May 2nd, 2026. I'm AI Ryan Matta. Quick note, the real Ryan is busy this morning, but the script you're hearing was written by him, and the AI version of me is just here to deliver it without the coffee breaks. Today, we're walking through the 5 biggest Bitcoin stories of the past 7 days. We'll cover the channel breakout that just confirmed on the daily chart, Jerome Powell's last ever FOMC meeting, and what Kevin Warsh taking over means for risk assets, Michael Saylor's latest $255 million Bitcoin buy, the April ETF flow numbers that quietly broke a 6-month pattern, and the on-chain data that explains why this whole setup looks coiled. Stick around for the big picture synthesis at the end. There's a thread running through all 5 of these stories that most analysts are missing. Let's start with the price action. Story number 1, Bitcoin broke the descending channel. Pull up a daily chart of Bitcoin from October 6, 2025, the day BTC printed its all-time high of $126,213. And what you'll see is a textbook descending channel, 2 parallel trend lines, both sloping down. Lower highs in November, lower highs in December, lower highs in January and February. The price kept getting compressed inside that channel, and every rally attempt ran into the upper trend line and got rejected. February of this year is where the floor of that channel finally got tagged, and Bitcoin printed $60,061 on the low. From peak to trough, that's a 52% drawdown. Painful, but actually shallower than past Bitcoin bear cycles, which is itself a sign of the maturing institutional bid. Then April happened. Bitcoin bounced off the channel floor, climbed back to 75,000 by mid-month, briefly tagged 79,000 on April 22nd. That was an 11-week high. Got rejected at the 80,000 wall, and then on this past Wednesday, it cleared the upper boundary of that descending channel. Decisively, a clean breakout. As of yesterday's New York Open, BTC was trading at $78,178, up about $1,800 from the prior morning. April closed up roughly 13%, the second straight green monthly close after 5 red months in a row. Now here's why this matters more than your average breakout headline. The descending channel had been the dominant technical structure governing this entire correction. Every algorithm, every quant fund, every chart-based trader on Wall Street had that channel mapped on their screens. When a structure that's been in place for 7 months gets broken, the algorithms reposition, the hedge funds that were short the channel start covering, the systematic trend followers that had been adding to shorts have to flip their bias. That's why these breakouts often accelerate after the first confirmation, and because the entire passive flow shifts at once. The 100-day moving average is now sitting at $72,352. That used to be resistance during the downtrend. Now it's support. Until BTC breaks below that line on a daily close, the bullish structure holds. Above us, the entire game is about 80,000. There's a massive cluster of short liquidations parked just above that level. Analysts are seeing it on the liquidity heat maps, and a clean daily close above 80 would force those positions to cover, which mechanically fuels more buying. The first target on a clean break is the 84 to 85,500 zone. Beyond that, the longer-term thesis pulls the chart back toward the prior all-time high at 126,000. That's not happening this month, but it's the structural target if the macro cooperates. So what could derail it? 2 things. First, oil. If Brent crude rebounds above 115 because the Iran peace talks fall apart and the Strait of Hormuz stays closed, risk assets across the board take a hit and Bitcoin pulls back with them. Second, dollar strength. If the DXY catches a bid because inflation prints hot, Bitcoin tends to soften. Watch those 2 macro variables alongside the 80,000 level on the chart. That's story number 1. Now to story number 2, the macro event that defined this week. Story number 2, Powell's last FOMC and the Warsh handover. Wednesday, April 29th, 2026, Jerome Powell walked into his final scheduled press conference as chair of the Federal Reserve. 8 years on the job, 3 rate hiking cycles, 1 pandemic, and he closed it out the same way he opened most of his recent meetings, by holding rates steady. The target range stayed at 3.5% to 3.75%. The vote was 8-4, meaningful dissent, and the official statement cited 2 things: persistent inflationary pressure from rising global energy prices and a, quote, high level of uncertainty driven by the Middle East situation. Markets had already priced this hold at near 100% on the CME FedWatch tool the day before. So the rate decision itself wasn't the event. The event was the language and the leadership transition. Bitcoin's reaction told you exactly how the room read it. BTC dropped from 76,200 down to roughly 75,000 in the first hour after the release. Then it stabilized, climbed back to 75,760, and by the next day had reclaimed 76. That's a textbook initial knee-jerk reaction, followed by a rebid as traders digested the substance. Now here's what really matters about this meeting. Powell's term as chair officially ends on May 15th. President Trump nominated Kevin Warsh back on January 30th. Warsh is a former Fed governor from the 2006 to 2011 era. He's been a vocal critic of recent Fed policy, and this is the part that has crypto traders paying attention. He has documented connections to the cryptocurrency industry. Multiple analysts have flagged Warsh as more likely to lean dovish on rate cuts in the back half of this year and more likely to be sympathetic to Bitcoin and digital assets as legitimate financial instruments rather than viewing them through a regulatory skeptic lens. If you've watched Bitcoin for any length of time, you know the rate cut cycle is the fuel. When the Fed cuts, the opportunity cost of holding non-yielding Bitcoin drops, the dollar weakens, and capital rotates from money market funds into risk assets. The reason Bitcoin has struggled so much in early 2026 is that the cuts the market priced in for this year keep getting pushed out. March CPI came in at 3.3% annual, well above the Fed's 2% target. Core PCE is tracking at 3.45%. Tariffs from the Trump administration are pushing goods prices higher. Powell could not justify cuts in this environment without losing credibility on inflation. Warsh, with a fresher mandate and a different reputation, may have more political space to start cutting if the data even mildly cooperates. And there's another angle here that doesn't get enough airtime. Iggy Iopi, the chief investment officer at the trading firm Theo, said something this week that I think is exactly right. He told the block that the most important catalyst for Bitcoin right now isn't the FOMC, it's the Clarity Act. The Senate Banking Committee is doing a markup session the week of May 11th. That's the first official Senate-level action on a bill that would formalize Bitcoin's status as a commodity under the CFTC, take it out of the SEC's regulatory ambiguity zone, and give U.S. banks the ability to hold Bitcoin without prohibitive capital requirements. Translate that out of policy speak. If banks can custody Bitcoin without the current capital penalty, you suddenly unlock trillions of dollars in potential demand from institutions that today can't touch it. That's not a price action catalyst. It's a structural demand catalyst. And the timing of the Clarity Act sliding through the Senate while Warsh takes over the Fed in mid-May is, for lack of a more sophisticated word, wild. So Powell's last meeting was procedurally a non-event. Strategically, it was the changing of the guard at the most important monetary institution on earth right when the regulatory framework around Bitcoin is about to flip. The market is watching this carefully, and whether you're bullish or bearish, you should be watching it too. Story number 3, Saylor bought another $255 million of Bitcoin. On Monday morning, April 27th, Michael Saylor posted on X that Strategy, the company formerly known as MicroStrategy, purchased an additional 3,273 Bitcoin between April 20th and April 26th. Average price, $77,906 per coin. Total spend, roughly $255 million. Funding for this round came from issuing about 1.5 million shares of Strategy's common stock, which is currently trading at about a 21% premium to net asset value. That brings Strategy's total Bitcoin holdings to 818,334 BTC, total cumulative spend, roughly $61,810 million. Average cost basis across all purchases, $75,537 per coin. With Bitcoin trading at 78,000 and change, Strategy's entire position is now back in profit on paper, after spending most of January, February, and March underwater. Saylor reported a year-to-date Bitcoin yield of 9.6% for 2026. Bitcoin yield is a metric Strategy uses to track how much their Bitcoin per share has grown net of dilution from new equity issuance. A 9.6% yield in 4 months is, by their accounting framework, extraordinary. It means they're effectively compounding shareholder Bitcoin exposure at a much faster rate than just buying spot. Step back and look at the magnitude of what's happening here. 818,000 Bitcoin is roughly 3.9% of all the Bitcoin that will ever exist. One company, one CEO with a thesis. Strategy now holds more Bitcoin than BlackRock's iShares Bitcoin Trust, which had previously been the largest publicly disclosed holder. The only entity sitting on more than Strategy is the dormant cluster of wallets attributed to Satoshi Nakamoto, which haven't moved in 15 years and almost certainly never will. The pattern of buying is what should grab your attention. Earlier in April, Saylor disclosed a 34,000 Bitcoin purchase for $2.54 billion, his largest single week buy in 17 months, then $1 billion, then a quarter billion. He paused briefly in late March, came back hard the first 2 weeks of April, and is still buying as the price approaches 80,000. The financing has shifted away from common stock dilution toward issuing preferred stock, STRC and STRF, which carry double-digit dividend yields and don't dilute existing equity holders the same way. Strategy reports Q1 earnings on May 5th. That's 3 days from when this video goes up. Saylor will give the public a clean, on-the-record signal about whether the weekly buying continues. If Q1 was, as 24/7 Wall St. put it, the worst quarter on record for strategy, and Saylor still doubles down on the buying program at the earnings call, that's a major statement of conviction. If he hints at any moderation, the algorithmic correlation between strategy stock and Bitcoin will react fast. There's a reason I keep covering strategy on this channel. It's not because Saylor is a charismatic spokesperson, though he is. It's because strategy has become, in effect, the proof of concept for corporate Bitcoin treasury adoption. If a publicly traded company can buy $62 billion of Bitcoin, finance it through the public markets, and outperform every other capital allocation strategy on the planet over a 5-year window, and they have, then the question for every other CFO in America is, why aren't you doing this? That's the conversation that's quietly happening in boardrooms, and it doesn't end. Story number 4, ETFs just had their best month since October. Spot Bitcoin ETFs took in $2.44 billion of net inflows in April 2026. Strongest institutional buying month since October 2025, the same month Bitcoin printed its all-time high. 8 consecutive weeks of net positive flows. Total cumulative inflows since launch, roughly $58 billion. Total assets under management across the 11 products, north of $102 billion. To understand why this matters, rewind your tape to early 2026. From November 2025 through February of this year, Bitcoin spot ETFs lost more than $6 billion in net outflows. That coincided with the worst Q1 in Bitcoin's history, the first time ever that January, February, and March all closed red. The narrative was that institutions had gotten what they wanted at the top, taken profits, and rotated out. Then April flipped that script entirely. 8 straight weeks of inflows. April alone took in nearly half of what was lost across that 4-month outflow window. BlackRock's iShares Bitcoin Trust, IBIT, controls roughly half of the entire market, with around $54 billion in assets. Fidelity's FBTC is the second largest at about $14 billion. The flows are concentrated, the buying is institutional, and the consistency, 8 weeks without a single weekly outflow, is the kind of signal that suggests these are systematic allocators, not tactical traders chasing momentum. Why does this matter for the price? Because every dollar that comes into a spot Bitcoin ETF gets converted into actual Bitcoin held in custody. That's not paper exposure. The custodian, usually Coinbase custody, has to go to the open market and buy real coins. $2.4 billion of inflows in April at an average price somewhere around 73,000 means roughly 33,000 Bitcoin got pulled off exchanges and locked into ETF cold storage. That supply doesn't come back unless ETF holders sell their shares, which triggers redemptions on the institutional side. That dynamic feeds directly into story number 5, and this is where it gets really interesting. Story number 5, exchange reserves are at a 7-year low and whales are buying like it's 2013. Take 2 simultaneous on-chain signals and put them side by side. First, the total amount of Bitcoin held on centralized exchanges has dropped to roughly 2.21 million BTC. That's just 5.88% of the circulating supply. The last time exchange reserves were this low was December 2017, the month Bitcoin first broke $20,000 during the original retail-driven mania. Over the past 30 days alone, a net 48,200 Bitcoin have left exchanges. On March 7th, in a single trading session, 32,000 Bitcoin, worth roughly $2.26 billion at the time, exited exchanges. That was the largest single-day outflow ever recorded. Second signal, whale wallets, defined as addresses holding 1,000 Bitcoin or more, accumulated 270,000 Bitcoin over the past 30 days. 270,000, largest monthly accumulation by whales since 2013. The number of whale addresses grew from 2,082 at the end of December to roughly 2,140 today. 58 new whale wallets in 5 months, while the existing whales stack harder than they have in a decade. Now connect those 2 signals. Coins are leaving exchanges. Coins are being absorbed by long-term holders. Available sell-side supply on order books is the lowest it's been in 7 years. And on the demand side, ETFs are bidding 8 weeks straight. Strategy is buying every week. And whale accumulation is at a 13-year peak. This is the textbook setup for a supply squeeze. When demand returns at scale and the float is this thin, even modest buying can produce disproportionate price moves. The historical analog matters. The last time exchange reserves were anywhere near this low was mid-2019. Bitcoin was trading around $5,000. Over the next 12 months, it rallied roughly 180% to 14,000. That's not a guarantee. Past performance, you know the rest. But when you see this kind of structural supply contraction overlap with institutional accumulation, you're not looking at a bear market continuation. You're looking at the kind of accumulation phase that precedes major recoveries. CryptoQuant CEO Ki-Young Ju put it about as plainly as I've seen anyone put it. He said exchange whale ratio decline with accelerating outflows signals large holders shifting from distribution to accumulation. James Check, the lead on-chain analyst at Glassnode, framed the dynamic in terms of who's selling versus who's buying. He noted that when short-term holder realized losses cross $1 billion per week and long-term holders are simultaneously adding to positions, you're watching textbook smart money accumulation. Retail is selling at a loss. Institutions are buying with conviction. That handoff has happened before every major Bitcoin recovery in the last 12 years. And here's the kicker that ties everything together. Despite all of this, the whale accumulation, the supply squeeze, the ETF inflows, the strategy buying, the channel breakout, sentiment readings still show fear. The fear and greed index has been in fear or extreme fear territory for 60 plus consecutive days, the longest streak since FTX collapsed. Funding rates on Bitcoin futures have been negative for 60 days too. Negative funding means more traders are paying to be short than to be long. The 30-day average funding rate sits at negative 5% versus a historical norm of positive 8%. Now, there's a sophisticated read on that negative funding that you should understand. Marcus Thielen at 10x Research, sharp guy, he gets quoted everywhere, has argued that the negative funding isn't actually directional bearish positioning. It's the institutional carry trade. Institutions are long spot Bitcoin through ETFs and short Bitcoin futures simultaneously, locking in the basis spread as a low risk yield trade. And they're not betting on Bitcoin going down, they're harvesting the funding spread. When that trade unwinds or when retail finally capitulates and stops shorting, the funding normalizes. And historically, these prolonged negative funding streaks have ended with violent upside moves once the structure resolves. Big picture. Let me pull these 5 stories together because the thread connecting them is the actual investment thesis. Bitcoin just broke a 7-month downtrend on the chart. The Federal Reserve is days away from a leadership change that points toward easier monetary policy in the second half of 2026. The largest corporate buyer in the world is still buying every week $255 million of fresh demand. Spot ETFs have been bidding for 8 straight weeks, putting more Bitcoin into cold storage every day. Whales are accumulating at a 13-year peak. Exchange reserves are at a 7-year low. The Clarity Act is moving through the Senate in 2 weeks. And against all of that, the average investor on Twitter, the average retail trader, the average Reddit thread is in fear and shorting the rally. That divergence between the on-chain structure and the sentiment surface is exactly the kind of divergence that historically resolves with sharp upside moves, not with continued grinding lower. I'm not making a price prediction for this month. I'm not telling you Bitcoin hits 100 grand by June. What I am telling you is that if you've been a Bitcoin holder through this 6-month correction and you're staring at the chart wondering whether to capitulate, the fundamentals say the opposite. The setup right now looks more like an accumulation phase ending than a bear market beginning. The risks remain real. If Iran's peace proposal collapses and the Strait of Hormuz fully shuts, oil rips to 130 and the macro tape gets ugly fast. If inflation prints hot for the second straight month, Warsh's hands get tied on cuts the same way Powell's did. If Strategy's Q1 earnings show weakness in the buying program, the market loses its anchor demand. These are not trivial risks, but they're the known risks. The setup beneath those risks, the supply, the institutional bid, the regulatory tailwind, the technical breakout, that's the strongest configuration Bitcoin has had since last fall. This is why I built bitcoinmaxing.com to give people a free, no-nonsense Bitcoin retirement calculator. You plug in what you have, what you can save, and what you think Bitcoin's compound annual growth rate looks like over your time horizon, and it tells you what your stack could be worth at retirement. It is totally free, no upsell, no nonsense. If you've been on the fence about whether Bitcoin's worth it for the long run the numbers yourself. Links in the description. Subscribe to the channel for next week's roundup, the daily Bitcoin reports, and the precious metals coverage every Wednesday. And I'll see you in the next one.